Satoshi Nakamoto is the pseudonym used by Bitcoin's mysterious creator. Who is Satoshi Nakamoto? Despite creating a trillion-dollar asset, their true identity remains unknown. On January 3rd, 2009, Satoshi mined the first Bitcoin block, embedding a Times headline about bank bailouts, perhaps suggesting their motivation to create an alternative financial system. Many theories exist about Satoshi's true identity. Some believe it was a single cryptography expert, while others suggest it could be a group of developers working together. More unusual theories suggest government involvement, or even, humorously, that Satoshi might be a time traveler from the future. Satoshi's anonymity serves several important purposes. It protects Bitcoin from centralization and prevents any single point of authority. It allows the technology to speak for itself rather than being associated with a specific individual. And of course, it creates an aura of mystery that has only added to Bitcoin's mystique. Satoshi is estimated to have mined about 1 million Bitcoin in the early days, worth tens of billions of dollars today. Remarkably, these coins have never been moved. Satoshi's last known communication was in April 2011, simply stating, "I've moved on to other things." And with that, Bitcoin's creator vanished into digital legend. Bitcoin officially launched on January 3rd, 2009, when the Genesis block was mined by Satoshi Nakamoto. The Genesis block contained a hidden message, a headline from the Times newspaper about bank bailouts, timestamping Bitcoin's birth, and hinting at its purpose. 9 days after the Genesis block, on January 12th, the first ever Bitcoin transaction took place. It was like sending digital fairy dust from one computer to another. Satoshi Nakamoto sent 10 Bitcoins to programmer Hal Finney, who became the first person other than Satoshi to use the Bitcoin software. Early Bitcoin mining was much different than today. Anyone with a home computer could mine Bitcoin, as specialized mining hardware didn't exist yet. This was the beginning of Bitcoin's journey from concept to reality. A new financial network was forming, completely independent from traditional banking systems. Let's look at some key milestones in Bitcoin's early days. In 2024, Bitcoin experienced a significant price surge, driven by several factors. One of the most impactful events was the approval of Bitcoin ETFs by the U.S. Securities and Exchange Commission. But what exactly are Bitcoin ETFs? ETFs, or exchange-traded funds, are investment products that track the price of Bitcoin. Unlike buying Bitcoin directly, these ETFs trade on traditional stock exchanges that investors already use. They're also regulated investment products, providing an extra layer of security and oversight that appeals to traditional investors. The launch of Bitcoin ETFs had a dramatic impact on the market. Within the first few months, these ETFs attracted billions of dollars in investment inflows. They expanded market access by allowing investors to gain Bitcoin exposure through their existing brokerage accounts. This led to increased institutional adoption, as pension funds, endowments, and other large investors could now add Bitcoin to their portfolios within their existing regulatory frameworks. Perhaps most importantly, ETF approval provided Bitcoin with a new level of legitimacy in traditional financial markets. Think of Bitcoin ETFs like buying a slice of pizza instead of the whole pie. Traditionally, investing in Bitcoin meant buying and storing the actual cryptocurrency yourself, like buying a whole pizza. But with ETFs, you can invest in just a fraction of Bitcoin through a familiar investment vehicle, like buying just the slice you want. Bitcoin ETFs offer several advantages for traditional investors. First, investors don't need to deal with crypto wallets or manage private keys. They also gain protection through a regulated investment environment with familiar custodial safeguards. Investors can use their existing brokerage accounts and receive standard tax forms, making the investment process simpler. And perhaps most importantly for long-term investors, Bitcoin ETFs open the possibility for inclusion in retirement accounts like 401ks and IRAs. The 2024 approval of Bitcoin ETFs represented a crucial milestone in Bitcoin's journey toward mainstream adoption, significantly contributing to the year's price surge. Bitcoin's price movements have been compared to a roller coaster ride, with dramatic ups and downs that can occur within days or even hours. Looking at Bitcoin's price history in 2021, we can see it started around $30,000, peaked at over $67,000, then declined again, all within a single year. Several factors contribute to Bitcoin's volatility, including media coverage, regulatory announcements, market sentiment, and institutional investment decisions. Analysts are divided on Bitcoin's future price. Bullish analysts predict prices exceeding $70,000 in 2025, citing increasing institutional adoption and diminishing supply due to halving events. On the bearish side, concerns include economic uncertainties, potential regulatory crackdowns, and risks of market manipulation. These factors could lead to significant price declines. Historically, Bitcoin has experienced multiple drops of over 80%, with recovery periods lasting 2 to 3 years. However, each cycle has reached progressively higher peaks. This chart shows the MVRV ratio, a metric that helps identify market tops and bottoms. When the ratio is high, Bitcoin is potentially overvalued, and when it's low, Bitcoin might be undervalued. Bitcoin's market capitalization has grown significantly over time, but with considerable volatility, as seen in this chart comparing Bitcoin to other cryptocurrencies. Even the most accurate prediction models can't account for unexpected events or black swan scenarios that might impact Bitcoin's price. Bitcoin's price movement has been increasingly correlated with traditional markets in some periods, while remaining independent in others, adding another layer of complexity to price predictions. Bitcoin's price volatility is both its greatest attraction and biggest risk. Investors should understand this inherent unpredictability before participating in the market. Bitcoin is no longer just for tech enthusiasts and retail investors. Increasingly, institutions and corporations are adding Bitcoin to their balance sheets. Major corporations like MicroStrategy and Tesla have made significant Bitcoin purchases. MicroStrategy leads with over 71,000 Bitcoin, while Tesla holds 43,000. Institutions are adopting Bitcoin for several strategic reasons: as an inflation hedge, for portfolio diversification, long-term growth potential, and protection against currency devaluation. Even nation-states are exploring Bitcoin adoption. El Salvador made history as the first country to adopt Bitcoin as legal tender, with other nations now researching similar strategies. This institutional adoption has significant market implications: increased liquidity, reduced long-term volatility, greater public awareness, and development of regulated infrastructure. This growing institutional adoption represents a major shift in Bitcoin's journey from a niche asset to a mainstream investment, signaling increasing confidence in its long-term value. The regulatory landscape for Bitcoin is complex and constantly changing. Regulations serve to balance innovation with consumer protection. In the United States, several regulatory bodies are involved, with the Securities and Exchange Commission playing a significant role. We're seeing increasing political support for cryptocurrencies, with many political figures taking pro-crypto stances. This growing support is bipartisan, with legislators on both sides recognizing the potential of blockchain technology. A significant development has been the establishment of cryptocurrency advisory councils. These councils bring together industry experts and government officials to develop informed regulatory approaches. Regulatory developments have a significant impact on Bitcoin's price and adoption. Clear regulations tend to boost market confidence, while uncertainty can lead to volatility. Looking ahead, regulatory clarity will be crucial for Bitcoin's continued growth and adoption. The ideal regulatory framework will balance innovation with consumer protection while fostering the development of global standards. Bitcoin's market performance in 2025 has been nothing short of a roller coaster ride. Bitcoin started 2025 with explosive growth, surpassing the $100,000 mark for the first time in history. This unprecedented growth was largely driven by high demand from U.S. spot Bitcoin ETFs, which made it easier for traditional investors to gain exposure to Bitcoin. However, The first quarter of 2025 proved challenging for Bitcoin, with a significant downward trend following the initial surge. Bitcoin's price displayed significant volatility, continuing its historical pattern of boom and bust cycles. When viewed in a broader historical context, Bitcoin's 2025 performance follows patterns seen after previous halving events, where initial price surges are often followed by corrections. Despite the volatility, Bitcoin continued to maintain its position as the dominant cryptocurrency by market capitalization in 2025. To summarize Bitcoin's 2025 market performance, we saw a historic breakthrough above $100,000, driven by ETF demand and institutional adoption, followed by first quarter volatility and correction, all of which follows Bitcoin's post-halving historical patterns. As 2025 continues, Bitcoin's market performance remains dynamic, reflecting its evolving role in the global financial landscape. Decentralization is the foundation of Bitcoin's revolutionary approach to money. Unlike traditional financial systems, where banks and governments are in control, Bitcoin distributes power among all participants. In decentralized systems, power and control are distributed among all participants in the network, rather than concentrated in a single authority. Bitcoin is like a digital town square, where everyone has a copy of the rules and can verify that they're being followed. This is achieved through a peer-to-peer network of computers or nodes that maintain the Bitcoin blockchain together. Decentralization offers several key benefits that make Bitcoin unique and resilient. With no single point of failure, Bitcoin can't be shut down by targeting any one entity. It's resistant to censorship, operates without requiring trust in a central authority, and is accessible to anyone with an internet connection. This revolutionary technology has applications beyond just currency, including healthcare, legal contracts, and cybersecurity. When we compare centralized and decentralized systems, we can see fundamental differences in how they handle data, communication, and decision-making. For Bitcoin users, decentralization means no bank or government controls your money. The network remains operational even if some nodes fail. Transactions can't be censored, and anyone can participate without needing permission. This fundamental principle of decentralization is what truly gives power back to the people. Blockchain, the unbreakable ledger. Every Bitcoin transaction is recorded on a public distributed ledger called a blockchain. Think of blockchain as a giant, unchangeable spreadsheet that everyone can see. It keeps a record of all transactions: who sent Bitcoin, who received it, and how much was transferred. What makes blockchain special is that it's distributed. Unlike traditional ledgers kept by a single authority like a bank, every participant in the Bitcoin network has a complete copy of the blockchain. A blockchain is a series of connected blocks. Each block contains transaction data and a unique identifier called a hash. Each block also references the previous block's hash, creating a chain. One of blockchain's most important features is that it's immutable, meaning once data is recorded, it cannot be changed or deleted. If someone tries to alter a transaction, the change would create a different hash. Since all other participants have their own copy of the blockchain, the network would immediately detect the tampered block and reject it. The blockchain provides Bitcoin with key benefits: transparency, as all transactions are public; security through cryptographic verification; immutability, meaning records can't be altered; and decentralization with no single point of control. Bitcoin mining is the competitive process that creates new coins. Miners use powerful computers to solve complex mathematical puzzles, and whoever solves the puzzle first gets rewarded with freshly minted Bitcoins. Mining requires specialized hardware, usually high-end graphics cards or purpose-built ASIC machines. These powerful computers consume significant electricity and generate heat as they work to solve complex puzzles. As more miners join the network, mining difficulty increases, requiring even more powerful hardware. The mining process involves several steps. First, miners collect pending transactions into blocks. Then they race to find a special number called a nonce that, when combined with the block data and run through a hash function, produces a result that meets specific criteria. This is called proof of work. Whoever finds a valid solution first gets to add their block to the blockchain and receives a reward of newly created bitcoins. Today, most Bitcoin mining happens in large facilities called mining farms. These industrial scale operations house thousands of mining machines and are typically located in regions with cheap electricity. Many miners join forces in mining pools to increase their chances of earning rewards. However, these operations consume significant energy, leading to environmental concerns. The core of mining is solving a cryptographic puzzle. Miners must find a special number that, when combined with transaction data and run through a hash function called SHA-256, produces a result that starts with a specific number of zeros. This is purely trial and error, requiring millions of attempts. The difficulty of this puzzle adjusts automatically to ensure new blocks are created approximately every 10 minutes. Successful miners receive a reward of newly created bitcoins, currently 3.125 bitcoins per block. This reward halves approximately every 4 years in an event called the halving. Miners also collect transaction fees from users. The block reward system ensures that only 21 million bitcoins will ever exist, making Bitcoin a scarce digital asset. Bitcoin has a key feature that makes it fundamentally different from traditional money. There will only ever be 21 million bitcoins. This hard cap is encoded in Bitcoin software and cannot be changed without consensus from the entire network. Unlike traditional currencies that can be printed endlessly by central banks, Bitcoin's supply is mathematically limited. This chart compares the US M2 money supply, which continues to grow, with Bitcoin's fixed supply. Scarcity is a fundamental driver of value. Like precious metals or rare collectibles, Bitcoin's fixed supply makes each coin truly scarce. Bitcoin's scarcity affects how it correlates with other assets. This matrix shows Bitcoin's relationship with traditional investments like stocks, gold, and currencies. Bitcoin's scarcity increases over time through a mechanism called halving. Every 4 years, the rate at which new Bitcoins are created gets cut in half. This predictable scarcity is one of Bitcoin's most valuable properties, creating a form of digital gold that cannot be debased through inflation. Bitcoin ETFs represent a significant evolution in cryptocurrency investment. A Bitcoin ETF is a security that tracks the price of Bitcoin without requiring investors to directly own the cryptocurrency. Bitcoin ETFs solve several concerns that previously kept traditional investors away, including security, custody, and accessibility issues. Similar to how gold ETFs track gold prices, Bitcoin ETFs mirror Bitcoin's value, but with the simplicity of trading on traditional stock exchanges. The introduction of Bitcoin ETFs in early 2024 saw significant inflows, with providers like BlackRock and Fidelity attracting billions in investment. Bitcoin ETFs have transformed the market by increasing accessibility for institutional investors, enhancing price discovery, and potentially reducing volatility over time. Looking ahead, Bitcoin ETFs are projected to attract between $25 and $50 billion in 2025 as they expand globally and develop more specialized products. As Bitcoin ETFs continue to mature, they will likely play a crucial role in bringing cryptocurrency investments into mainstream financial portfolios. Regulatory clarity is becoming a crucial factor in the cryptocurrency landscape. Clear regulations are essential for the crypto ecosystem. They create trust, protect investors from fraud, and establish clear operating rules for all participants. Stablecoin regulations are a perfect example of regulatory progress. Frameworks like the one from Singapore's Monetary Authority ensure stability, establish capital requirements, create clear redemption policies, and mandate transparent disclosures. Clear regulations establish standardized compliance processes that businesses can follow with confidence. This creates a level playing field and reduces operational uncertainty. Regulatory clarity drives market growth by giving institutional investors confidence, increasing retail adoption, and allowing for the development of new cryptocurrency products. Of course, there are challenges in creating effective regulations. We must balance innovation with investor protection, address cross border differences, keep up with rapid technological change, and find the right regulatory approach. When properly designed, regulations promote stability and broader adoption while maintaining the innovative potential of blockchain technology. The goal is to protect users while enabling growth. As regulatory frameworks continue to mature around the world, wider adoption of cryptocurrencies and blockchain technology will follow. Bitcoin halving is a scheduled event where the reward for mining new blocks is cut in half. This diagram shows the Bitcoin halving timeline, starting from the Genesis block in 2009. Each halving reduces the amount of new Bitcoin created. Let's understand how halving works. Initially, miners received 50 Bitcoin per block. This reward has been cut in half every 4 years. This chart visually represents the decrease in block rewards over time, from 50 Bitcoin per block in 2009 to just over 3 Bitcoin after the 2024 halving. Halving events have historically correlated with significant price increases in the Bitcoin market. This happens because the rate of new supply entering the market is suddenly cut in half. This chart shows Bitcoin's price history with vertical bands marking each halving event. Note the significant price increases that followed each halving. Bitcoin's supply economics are key to understanding halvings. Bitcoin has a maximum supply cap of 21 million, with approximately 19.5 million already mined by 2025. Each halving reduces the inflation rate by 50%. This table shows the complete Bitcoin halving schedule from launch in 2009 to its conclusion in 2140, when all 21 million Bitcoin will have been mined. A popular way to understand halving's impact is through the stock-to-flow model, which predicts Bitcoin's value based on its scarcity. Each halving increases Bitcoin's scarcity, potentially driving up its value. This chart shows the stock-to-flow model and Bitcoin market cycles. The model suggests that as halving events reduce new supply, Bitcoin's price could potentially reach significant new heights by 2027. Looking ahead, the next Bitcoin halving is expected in 2028, which will reduce the mining reward to approximately 1.56 Bitcoin per block. Based on historical patterns, this could trigger another significant market cycle. Blockchain technology is increasingly being integrated into traditional banking and financial services, creating a bridge between innovative technology and established financial systems. Financial giants began exploring blockchain technology as early as 2014. This trend accelerated through 2017 as major banks, investment firms, and credit card companies invested in blockchain startups. Blockchain offers significant advantages for financial institutions. It dramatically reduces settlement times from days to just minutes. By eliminating intermediaries, it lowers transaction costs. The technology also enhances transparency by creating permanent, immutable records that all parties can trust. And it improves security through strong cryptographic protection of financial data. Here's a real-world example of blockchain's impact on trade finance. Traditional trade finance involves multiple intermediaries, paper documents, and lengthy processing times. With blockchain, the process is streamlined through a shared digital ledger, reducing complexity and delays. Financial institutions are implementing blockchain in several key areas. Cross-border payments and remittances now execute in seconds instead of days. Smart contracts automate compliance and verification processes. Banks are also using blockchain for secure digital identity verification and for tokenizing traditional assets like real estate and securities, making them more liquid and accessible. Not all blockchain projects in finance succeed. Financial institutions must carefully evaluate use cases to determine where blockchain truly adds value. Despite the hype, blockchain works best for specific scenarios requiring trust between multiple parties with conflicting interests. Looking ahead, we'll see deeper integration through central bank digital currencies, the incorporation of decentralized finance features into traditional banking, and standardized blockchain protocols specifically designed for the finance industry. In 2021, El Salvador made history by becoming the first country in the world to adopt Bitcoin as legal tender. President Nayib Bukele championed the Bitcoin law with several ambitious goals. He aimed to bank the unbanked, which represented about 70% of the population, reduce remittance costs for Salvadorans abroad, attract investment and innovation, and create economic growth. The implementation was ambitious. The government launched the Chivo Wallet, a digital wallet application, and gave every citizen $30 in Bitcoin as an incentive. More than 200 Bitcoin ATMs were installed throughout the country, and businesses were required by law to accept Bitcoin as payment. The national adoption was inspired by Bitcoin Beach, a project in El Zonte, a small beach town that had already created a functional Bitcoin economy years before the national law. This grassroots experiment showed that Bitcoin could work for everyday transactions, even in a small community. El Salvador's Bitcoin experiment has shown mixed results. On the positive side, over 4 million Salvadorans have used the Chivo wallet, tourism has increased by about 30%, and more than 50 Bitcoin companies have established operations in the country. However, challenges remain, including concerns about Bitcoin's price volatility, a steep learning curve for many citizens, and criticism from international financial institutions like the IMF. El Salvador's bold Bitcoin experiment continues to be watched closely by nations worldwide, as it provides the first real-world test case of a country adopting cryptocurrency as legal tender. Virunga National Park, located in the Democratic Republic of Congo, is home to 1/3 of the world's endangered mountain gorillas and incredible biodiversity. The park faces significant challenges, including armed conflict, limited funding, and poaching threats to its wildlife. Conservation efforts require sustainable funding to protect this vital ecosystem. Park authorities developed an innovative solution by building hydroelectric power stations. These dams generate more electricity than local communities can use, creating an opportunity for innovative funding. The park's innovative solution, using excess hydroelectric energy to power Bitcoin mining operations. They also supplement with solar energy, creating a sustainable mining operation that monetizes surplus electricity without environmental harm. The process is elegantly simple. Excess hydroelectric energy powers Bitcoin mining operations, generating revenue that directly funds conservation efforts. This creates a sustainable funding model that doesn't rely solely on tourism or donations. The impact of this innovative approach has been remarkable. Bitcoin mining revenue funds ranger salaries and equipment, supports guerrilla protection programs, provides electricity to local communities, and creates a sustainable funding model independent of tourism fluctuations. Virunga National Park stands as a pioneering model of how cryptocurrency mining can be harnessed for environmental conservation when powered by renewable energy. This innovative approach creates a sustainable funding source while minimizing environmental impact. Silk Road represented Bitcoin's earliest association with illicit activities. Operating on the dark web from 2011 to 2013, the Silk Road was an anonymous online marketplace accessible only through specialized software called Tor. The marketplace was created by Ross Ulbricht, who operated under the pseudonym Dread Pirate Roberts. The Silk Road facilitated anonymous transactions using Bitcoin as its exclusive payment method. Bitcoin's pseudonymous nature made it perfect for Silk Road transactions. With no central authority monitoring payments, transactions couldn't be easily traced to individuals, allowing users to make payments without revealing their identity. In October 2013, the FBI shut down the Silk Road and arrested Ross Ulbricht. He was later sentenced to life imprisonment without the possibility of parole. The Silk Road had a lasting impact on Bitcoin's reputation. Its early association with illegal activities led to increased regulatory scrutiny of cryptocurrencies, while media coverage often focused on the criminal aspects rather than Bitcoin's technological innovations. Despite its shady beginnings with platforms like the Silk Road, Bitcoin has evolved beyond these early associations to become a legitimate asset class embraced by mainstream institutions. When it comes to Bitcoin's future, everyone wants to know what the experts think. Let's explore some price predictions from the crystal ball gazers of crypto. Many analysts use pricing models like the Bitcoin Rainbow Chart to make their predictions. This logarithmic scale shows Bitcoin's historical price bands and potential future trajectories. Plan B, known for the stock-to-flow model, predicts Bitcoin could reach $250,000 or more by end of 2025, based on Bitcoin's scarcity and historical halving cycles. Cathie Wood of ARK Invest offers a more moderate prediction of $180,000 to $200,000, citing institutional adoption and Bitcoin's growing role as a store of value. JP Morgan analysts present a more conservative view of around $150,000, accounting for market volatility and potential regulatory hurdles. Several key factors influence these expert predictions. These include the pace of institutional adoption, regulatory developments around the world, broader macroeconomic conditions, and the impact of Bitcoin's halving cycles. While experts' specific price predictions vary, there's a general consensus that Bitcoin will reach new all-time highs in the coming years. The average prediction hovers around $180,000, though there's uncertainty about exact timing. Most experts agree on Bitcoin's long-term growth potential. It's important to remember that while experts use sophisticated models and analysis, their predictions are not guarantees. Market patterns can change, and unexpected events can impact prices dramatically. Always do your own research before making investment decisions. Cryptocurrency ownership has nearly doubled since the end of 2021, with Bitcoin leading this remarkable growth. Looking at web traffic to peer-to-peer cryptocurrency platforms, we can see significant regional differences in adoption. Central and Southern Asia lead in platform adoption, with Latin America showing consistent growth. Africa's adoption is rising at the fastest rate globally. The Bitcoin community is predominantly young, with over 70% of users under the age of 45. Bitcoin infrastructure continues to expand globally, with thousands of Bitcoin ATMs now available worldwide. As cryptocurrency adoption grows, investors are increasingly diversifying their portfolios beyond just Bitcoin. The numbers are impressive. Global crypto users have surpassed 420 million. Over 425,000 businesses now accept Bitcoin payments, and institutional investment exceeds $45 billion. As we can see, Bitcoin's popularity continues to grow across regions, age groups, and various use cases.